Welcome back. A normalization in coal prices and poor rail performance at Transnet Freight Rail have weighed on Thungela Resources. During the first half, headline earnings per share more than halved to just over R9.50, which are further translated in its dividend being slashed by 80% to R2. Joining me to take us through the 6 months that was is company CEO Ndlovu. Thank you so much for your time, July. Let's actually start off there with the softer pricing that we have seen in the coal market. What is the biggest hurdle in terms of the drivers of the softer price environment?
Thank you for inviting me. I guess one should always provide context when you talk about softer prices, because we're coming off the super high prices in 2022 and 2023. We all tend to think of them as normal, but actually those are once in a generation black swan driven prices. What we're actually beginning to see is more normal prices. And therefore we as a business, if we were to be successful, we want to be able to generate cash flows at these kind of prices. What is driving prices today? Really, it's those geopolitics, continued pressure to decarbonize. But on the plus side is very robust demand in the emerging markets. And 2023 was a record year in terms of demand at 8.7 billion tons. And we continue to see that demand hold in the key markets that we serve.
So, July, are you saying that because, of course, you mentioned the different kind of demand dynamics on the plus side and also on the negative side? You talk obviously about the softer demand when it comes to decarbonization, but would you say that that is still a small part of the demand dynamics compared to the demand that we are still seeing at this point and that we will continue to see?
That's right, because I think one has to recognize that although we're seeing a reduction in demand in particularly the US and Europe, coal being replaced by gas, the extra demand we're seeing coming out of India, China, Pakistan, Vietnam, even places like Indonesia, far outweighs the reduction that we're seeing in the global northwest. And for that reason, that's why we continue to say the fundamentals are supportive.
All right. Well, let's talk about what is happening, of course, here back at home in terms of the headwinds that you are experiencing with Transnet Freight Rail. I do understand, obviously, that it did have an impact on these numbers. But at this point where we are standing, are you seeing a bottom in terms of the headwinds there, in Transnet? Do you think that we are there, we've reached it, or we are close to reaching it? And maybe are we starting to see some green shoots in terms of momentum that we could see in the medium term?
That's how we would characterize where Transnet is today. The first step that the current leadership needed to take was to stop the bleeding. And quite frankly, if you look at half on half, I would say we are more or less where we were a year ago. Okay. But you should look at that in the context that what defined the results in this first half of the year were two big derailments. If you exclude that, actually we saw 4 months of pretty good performance by Transnet. The second thing to say is I'm actually quite pleased by the focus and energy that the new leadership is putting into improving the performance. And they're putting the effort in building the right building blocks to deliver the performance. That could be security, that could be procuring the critical spares. We're also beginning to see them bringing in new locomotives into the corridor, which is quite important in terms of providing a foundation for performance. The last comment to be made is this was quite an important milestone for us to gauge whether these improvements are real or not, was how quickly and successfully they would ramp up after the recent shutdown in July. And what we have seen is that this ramp up is materially better than the ramp up last year and the year before. Okay. For us, what we want to see is what is that tempo where they're going to settle at. But the work they've done is actually pretty good, and thus far we're seeing green shoots.
We'll talk about green shoots, July. Let's cross on over to interim in Australia. Of course, that's seeming to be an acquisition that is paying off. Talk to me about the momentum that we have seen there and that you do expect in the short to medium term.
So when we spoke to you in March, we said that we could see line of sight to improve this asset up to 4 million tons. I'm quite pleased by the work the team has done, that we are already there. And therefore, the trick really is going to make sure that we sustain that performance.
All right. And July, I mean, obviously looking at the priorities in terms of your capital allocation right now, what are they in the short to medium term?
The capital allocation for us is quite simple. We want to complete our key projects. That's why we've set aside money to complete Zibulo and Elders. Secondly, what we also want to be able to do is to prioritize the return to our shareholders. And that's why we distributed almost 50% of our adjusted operating free cash flow, because we prioritize that. But over and above that, clearly, if all the stars line up, we should start generating more cash on a go-forward basis.
All right, July, we need to wrap up the conversation, but just one last question. I know that your priority and your goal at this point is to control the controllables, but are there any outside factors, risks and opportunity that you have a close eye on?
The biggest opportunity for us in the first instance is to work with Transnet to unlock that constraint. I think that will unlock enormous value for us. But clearly, you know, Zinati, I mean, I've spoken to you before. We continue to look for opportunities similar to Ensham, where we have a right to win. And when we've got something, we'll talk to you guys.
All right, definitely. And looking forward to that. Thank you so much for your time and for your insights there, July. Much appreciated. That was the CEO of Thungela Resources, July Ndlovu.